in the Indian and emerging markets. Jeff Chowdhry, the senior portfolio manager at LGM Investments, joins us now to give us his world view and his view on the Indian markets. Jeff, it's a pleasure speaking to you. Things have really changed a lot since we last spoke. The US markets are now at record highs. India is virtually at a high. Are we expected to see better days yet?
Well, I think a couple of things. I think obviously people were concerned several months ago about, about President Trump. I think they were obviously concerned in India about demonetization. And I think it's fair to say that perhaps the worst fears for both have not yet been realized. Certainly in the case of President Trump, obviously he sort of tweets on a daily basis and he does concern people from time to time. But it's interesting that a lot of his advisors, seem to sort of come out afterwards and actually smooth the waters. I mean, as you saw in the last few days, we saw one of his senior advisors say that we want to sort of negotiate NAFTA with Mexico, but it needs to be good for both parties. And so as a result of that, the Mexican peso has rallied very strongly.
Jeff, hi, good afternoon. So what is the way forward? What's your current asset allocation strategy between emerging and developed markets?
Sure. I mean, we don't tend to do asset allocation. We tend to look at companies rather than sort of broad sort of asset allocation. What I would say is I think emerging markets as a whole, as an asset class, look pretty well positioned for a couple of reasons. I think the first thing is I think the US market, by any measure, is overvalued and overbought, and I think people who have to allocate money around the world have to be cautious of America because of the valuation premium it is to the rest of the world. The second thing I would say is that obviously some people are nervous about Europe because we've got elections coming up in France, Netherlands, and a number of other markets in Europe, and not all of those necessarily are pro-Europe parties as far as Europe is concerned. So I think people are a bit nervous. And obviously last year the big surprises were Brexit, which nobody thought was going to happen, and Mr. Trump, which nobody thought was going to happen. And so people are now saying, twice bitten, perhaps we'll be a little bit cautious this year.
I heard you say that emerging markets are cheap and underowned, but does India feature on that list? Because India is almost at a new high now.
Yeah, I mean, I think you should look at it in two separate ways. I think within the context of emerging markets, it's a relatively expensive market and it's a relatively over-owned market within emerging markets. But you've got to remember that because the asset class itself is under-owned, when people allocate, or ask global funds particularly, when they allocate to emerging markets, India is a very, very important part of that allocation. And so, don't be surprised to see more money coming into India this year from global funds and also passive funds as well, as people increase their allocation to emerging markets.
Okay, what about the rate hike from the Fed? Have investors digested that, or will there be any correction because of incremental rate hikes?
I think whether they raise interest rates in March or whether they raise rates later on in the year, I think largely people know that we're in an upcycle for rates. Largely people know that the economy means that interest rates are going in an upward direction. But I think you've also got to look at it in other parts of the world where interest rates are going in the other direction. So if you look at India, for example, we still think that interest rates can come down in India. Interest rates in Brazil have started to come down, and so we think it's there. So although they're going up in the one part of the world, it doesn't necessarily mean that that's bad for markets, particularly emerging markets, where in some cases they're going in the other direction.
In India, the sectors, Jeff, that have outperformed this year are the non-traditional sectors like telecom, metals, and even Reliance, after being dormant, has now started to perform. Do you like any of these spaces?
The way that we look at our stocks and our companies, we take a very, very long-term view. And we focus on companies which we think are going to grow their cash flows on a consistent basis over 5 to 10 years. So we don't get phased if you have a situation where some companies in cyclical sectors have a good return over 6 months or a year or whatever. What we're looking for is companies which we think are going to produce very good return for shareholders over the long term. And what that means for us is that we tend to focus much more on consumer companies, where we're more confident that they will generate those cash flows over the long term. And we also tend to focus our attention on private sector banks, where we think, again, companies can generate good returns. And that's why, as a result of that, we're not fazed by the fact that some cyclical companies may do well, or other companies that you've mentioned may do well over a short-term period, unless we have confidence that those companies can deliver good returns, as I say, over the next 5 to 10 years.
Okay, Jeff, what kind of growth do you see then for Indian market over the next 12 to 18 months? And are we looking at new highs soon?
Okay, well, I'll caveat that answer by saying I never make any forecasts for market levels or market returns, but I do see that more flows will come into the Indian market. I think a number of companies, particularly in the consumer sector, are starting to recover now from demonetization, from the shock of demonetization. And as a long-term India bull, I've been a bull of India since 1994, which goes to show how old I am. But I think, I continue to believe that emerging markets are a place to be, but particularly within emerging markets, India is the place to be. So don't be worried about the fact that the market is making new high this week or next week.
Okay. Well, what about sectors like technology, metals, telecom? Some of them are giving us good valuations. Anything that interests you there?
No, to be absolutely frank, no. I mean, I think the valuations in some cases are reasonably attractive. But as I say, for us, the most important thing is, can those companies deliver good long time returns, particularly in terms of generating good cash flows over the medium to long term. And if we are confident that those companies can do that, then we're obviously very happy to have those type of companies in our portfolio. So it doesn't have to be just large cap companies. I mean, we own companies like, Britannia, for example, Emami in our portfolio, which are not necessarily traditional large cap companies, but because we think those companies can deliver good cash flows over the next 5 to 10 years, we're very happy to own those in our portfolio.
Okay, Jeff, thanks a lot for your time today.